Okay, we have a futures contract here with or for half a year, so let's say that T is 0.5 years. Then also we have the spot price as 0. I'm not using indices, we can understand that this is down here. 1,200, let's say US dollar. And also the 6 months risk-free rate is 5%, so R 0.05.
Can you increase this on the page?
Yes, yes. Oh, thank you. Okay. Okay. Now it's good.
Yes, thank you.
Okay. Thank you for mentioning it. Okay, average dividend yield on this thing is so this about this index. So over the next 6 months is expected to be 2% per annum. So let's say this is mu. So expected growth. We can see it can be sometimes something different, but we can see that average dividend yield on something, so it's growing in some direction. So that's why you should not forget about or not be afraid to use this one. So how can we solve this? Of course, we have to jump back to the equations and we can say that which can it be? And yeah, so we have to talk about future contracts. And okay, all of them are future contracts, but it provides a rate at rate Q because it's has this one here. So let's color it with yellow. And maybe we can write it here. So now we will remember on it, not bring it to here. And then we can write this thing up. So okay, we have the spot rate, then we have the everything here above the Euler number, so we are using the exp function, and inside the exp function still we know that we have to take the difference between this R and this growth rate, and we have to multiply it with the time t, and after that it will be nice. Let's bold it. Now we have the solution, and if we are going back to the task here, you can see that I already did this one. So if we are adding everything back to the equation, then we have this result, and also we have it here as a solution. But I think that it's much more efficient to do it this way in different sheets, because it helps your work during the test. Okay, so next sheet and next job for us, commodity forward. It's funny because the book moves back and forth between forward and future contracts. Practically for us, pricing is the same, so it doesn't matter which one. It could be commodity futures contract as well, but okay, let's have it in sheet 2. So we have the current forward price as 0. Before continuing, then we can think about that, okay, but how can we price in this one? Let's go back here, and now we can say that, okay, but we have the right to buy, and this is practically at 0, just I made a mistake also on the slides. So we have a right to buy something at this price, and this is the future price, so what is the value of this thing? The difference and the present value of this difference. So this is not a good thing for us, because right now we are under this value, so I'm not expecting huge business success here. And minus R multiplied by time. We have this exp, and also there is the number here, so amount of ounces in this contract, and then we can see that this is what we get here. So if we are jumping back to the solution, not here, then we can see that, okay, one thing we should not miss here is the number. Just I have more decimals, but we can see. In the test, I will always ask for the whole number, so without any. Let's format this properly. So in this case, we have this commodity forward contract. Then, after this easy solutions, let's see this heavy one. So this is binary options. So in the case of binary options, we have an underlying share, and we have a derivative, this binary option, which have a tendency that it will pays off 100 if we are above some level. It doesn't matter what, that at least it should be above 40 US dollars, and if it's not meeting this condition at time t, then we are not using this, we will not get anything. And so that's why we can set the threshold as 40. So that's 0. $30 US, payoff 100, still in US dollars. The threshold when it pays is $40 US. Right now, we can think about it, okay? And the risk-free rate, continuously compounded as always, it's 3. And expected growth rate for the stock price. So expected growth rate. Okay, what was it? Okay, it was 3. Again, it can be confusing because the book uses the same numbers again and again. I still don't like this one, but okay. Volatility of the share price is 0.3, so we have at least 3 threes. So what can we do in this case? So first of all, we have to think about this expected payoff formula here. In this case, I think it's easier to go this way, not jumping back and forth, but we can remember that we had this equation when we had multiple blue lines in the slide, and then we can see that, okay, still this is just the probability. So we have to do many things after that, but at least we have the probability here. So we have normal distribution, we have all this data inside of it. So let's do the math. So first we will calculate this one, then we will utilize the normal distribution function, and then we will continue. So v divided by S0 for that side. So inside the normal distribution, then the utility. We could say that, okay, this is the calibration and this is the probability. Just I think it's easier to start this way. Okay, so we have a huge division mark here, so we have to put everything into brackets. Then there will be something under it. So now we can say that, okay, v divided by S0, so divided by S0, and all this thing is on ln, natural logarithm. Then we have to add all this expected value component and how it changes, so plus another bracket opens. Now we have the mu. Oh, it's plus or minus? Minus, okay. And volatility on, oh, let's put it also in brackets because I don't trust this one. Okay, all the brackets open, all the brackets are closed which were opened, and now we have to multiply volatility multiplies SQRT like square root with the time. We don't have time. Okay, so let's put it here, and it will be time 1. Yeah, and also here is time is missing, so this first bracket should be multiply, because okay, you can say, but I'm multiplying with 1, so it doesn't matter. But what would happen if it would be time in 2 years? Then we should rewrite everything. So if we are doing something, then it's much better to do it in a stable way. So now we have all the calibration data for the normal distribution. So now we have we can see that, oh, we have so many things: inverse normal distribution function, and we have standard normal cumulative distribution function. This is what we are looking for. So we have to set this one. Okay, let's check that I'm using the right function name. Yeah, okay, backwards. So we did all the maths here, and for some reason I have different results. But why? Because this is supposed to be negative and I have positive. Okay, let's compare. 30 minus 30 minus 40, yes. I had a mistake already in the first step. Yeah, now it's good. Okay, it was not a major mistake. Norm drift. Yeah, okay, there is an additional S because it's already a standardized normal distribution. So if I'm removing this one, then this is just a normal distribution function, so still I have to calibrate the mean, standard deviation, and it's cumulative. So if the difference is the same, that's it's supposed to be true. What? Yeah, okay, it's not MATLAB, sorry. True. We have this, but just for fun, let's have it with the different, so it's norm S dist. They are supposed to be completely the same, so it doesn't matter which function I'm using, just here I can calibrate, here I cannot. Okay, but the book uses this way. Just I wanted to show you what happens. Okay, so now we have the probability. So we can see that what is the probability that we are under this thing, and it's 15, nearly 16 percent of probability that we have this scenario that we will be not paid because we are under. So now we can calibrate the expected payoff. Let's copy this one. And it's quite simple because, okay, what do we have here? Probability, we did this, it's 15% or 16%. Then we have the payment, this nice 100 of money, and after that we just have to take the present value of this one. So well, let's use the steps. So this one, so nice that value of the derivative, actually present value of the cash flow what we calculated, so we can say that this money multiplied by exp minus r. Okay, this is confusing, I don't like this, that's why. R multiplied by time, which is 1 right now, and then we have another value, so we can have this here. This is in US dollars. And let's format it to nice numbers. Okay, maybe it's too nice. No. And we could say that, okay, end of task. But still we can continue. So what is happening when in the real life this is changing? Because market is changing. So now risk goes up. So prices are reflecting by this 10% of change. What can go wrong? It's already went wrong, so let's say that everything here. Okay, so that was the risk neutral word, and let's use italics. And now we can see that real world. New mu is 0.1. Okay, we have to recalibrate so many things here because now one thing is changing and this is only the mu. So luckily no other things should be modified. So that's why we can say that we will copy this equation, paste it here, then remember that the D8 should be changed to H8, and the mu never reappears again, so we can say that we added this modification due to the changes in the risk, and the rest of it can be copy and pasted. So because it was a stupid decision because still we are okay, let's use this one. Okay, this is good because it just refers upstairs, but this one was not a wise decision because we can fix it. F4. Now we can copy it. Okay, and also we can say that these guys are not changing, so we can fix them as well. And now we have the realistic version. So we can say that practically the value is changing in this case. So if we can say that the correct value of the derivative is the lower number, and we can deduce the correct discount rate. So practically we can say that, okay, the valuation is still okay, but the discount rate should be modified because of the trade-off between this mu value or the price changes in the real world. So that's why if we would redo the math, then we would be able to say that it's 36% and we are happy. Okay, we are not doing this because the book was also really lazy to do this, but we can expect that, okay, if we would take everything to pieces and then we rewrite the equation, then we can do this, but still we have a job to do. So let's move forward because we have the scenario analysis application. Until now we did not had, okay, later we at least we had some probabilities, but we had not to invert anything. B. So we have an expected return on stock in the real world, then we have a stock price nowadays, so spot rate, we have volatility and share number, and how much could you lose during the next year. So yes, we have to evaluate this, all of these things. So let's move forward, and let's start with a 0 because 30 US dollars. Then we have the mu, expected growth rate, and this is expected return, doesn't matter. Yep. 0.08. Okay, let's write it here, it's return, but doesn't matter, we know that this is the mu, and volatility is 0.25. Number of shares 1000, sorry, 10,000, several zeros back and forth, and yeah. So our main question is, how much can we lose? During the next year. Okay, so we can say that we can have 95% of chance that that will not happen, or 99% of chance, so we should compute or estimate for both. And in this case we can okay, this is utterly disgusting, so let's not use this one, but let's go back to, yeah, here it's still linear. So first of all we have to calculate this v value, the threshold, and then we can see that what is the difference between the threshold and the spot rate, and then the entire portfolio, and then we can have some conclusions. First we have to decide one thing, that we are above or under something, so this is what matters a lot. So if we are going even backwards, then we can see that if we are under this v, if we are under this v, then it's plus. If it's above this v, then it's minus. So we can assume that this will be minus. Yeah. Okay, so v. F0 multiplied with exp, bracket open, and let's close it, because it's easier to number or to remember that what I opened if I'm closing it immediately. Minus volatility on square divided by 2, and we're supposed to have also a time multiplicator here, which is missing again, because why not to miss it? So multiplied with this number here, during next year, so it's supposed to be there, just forgotten. Then we have also the normal distribution thingy here, but we already talked about it, that it's supposed to be minus. So let's say that norm inv. The probability in this case is 0.05. Okay, we could say that 1 minus 0.95 if we want to refer backwards. So even we can say that let's refer it from here, and hopefully it's understood that it's percentage. And we have to also multiply this volatility, because volatility, and it multiplies the time as it passes, SQRT square root of 1. I mean 1. Now let's see that what are the bugs here. Okay, if I'm writing here 0.95, are you able to work? No, it's not. Let's start to debug. Did we make this? Okay. Does this has a meaning? Sometimes it's easier to go stepwise, because in this case we don't have in this situation that I made a typo and then I have to dig up everything. Okay, the first part worked, so let's see the second half. Because obviously the problem will be located here. Okay, then why? Norminv? It's not working. Oh, this is a function error. Cool. Then let's see why. Norminv. So we need mean standard deviation. If we are using standardized normal distribution, then we don't need further calibration. So again, this calibration problem was present. Which is good, because in this case we just have to accept this, and then maybe we have the proper result here. If I'm not breaking the computer. No, we don't. Yes, I used norm sinf here. Yeah, I was wrong, so it's plus. Now it's good. Okay, so now we have this the threshold here. So let's see that what is happening when we are comparing the current stock price and the threshold and the entire amount of money in our hands. So say, no. We multiply it by the number of shares. And if I did everything right, and I did, then this is in US dollars. Then in this case we can send it to our treasury at the bank or investment company that we have to be focusing on this one. At least we should have such amount of equity or long-term underlying loans or something like this, or at least we should reserve such amount of cash, because if our losses will be under this level. So but what is happening if we have a really serious crisis on the market, and now maybe we can consider that this is not enough? Then we have to focus on these stressful scenarios. So we have an alternate case here, and let's copy everything. Just now we are saying that no, it's 99%, so right now it's not able to understand that this is, yeah, D7, and no, it's not D7, sorry, it's D4. Okay, the 14 is good, this one is not good, this is the D7. And now we can see that, yeah, maybe we should have even bigger collateral or yeah, free cash or reserve. Reserve is much better term for this one. So now we start to talk about something which is in the name of this course, because now we are managing risk. If we have such amount of money, then there is a high chance, or at least 99% of chance, that we are not going to default, which is a good thing. Okay, then what is happening when we have to compare this real and risk neutral words? So can we combine them? And of course we can. So in the real world, it generates scenarios out of time horizon. In risk neutral world, we can value our outstanding derivative transactions. So I think this looks like it's a mumbo jumbo, but let's see the actual problem, and we can understand what is the problem here and how can we solve this. So we have a portfolio which is funny because it has only a single 2-year forward contract. So 2 will be 2, 10 will be T will be 2, and the portfolio means that actually we can sell huge amount of shares, so 1 million shares on the stock. And right now the spot price is $50 US, and the delivery price in the forward contract will be 55. So we have to sell this and higher price than right now. Risk-free rate is 3%. Expected return on the stock is 10%. That's the mu. Volatility is 30%. Value of the portfolio might be after 6 months. So practically this is all the difference, because until now we were able to say that, oh, we can do this calculation, it's easy. But now we have to play with this 6 months, because now in the 6 months, so first half year, and then there will be remaining 1.5 year later. So and also loss has a probability of only 1% of being exceeded, so we have to combine this also into the equation. So let's see what is happening here. So let's write up the numbers first, and then we can start to analyze this. Let's open a new sheet. Okay, so big T will be 2. The problem is that we will have multiple T's, so let's say that T of contract, or let's say total 2 years. And now we can see that there will be, let's define a small t. So this will be the 6 months. 0.5 years. And big T minus small t will be the difference in years, because we will need both of them, so that's why practically we will need these two things. This one is not just in the text. Okay, number 1 million shares. S 0 50 US dollars. Then delivery price of the forward contract K. And then we have all these nice things, so risk-free rate. Okay, I was talking, so I forget this: 3%, 10%, 30%. Okay, volatility. I expect a return on the stock again, so okay. Value of the portfolio might after 6 months, and loss has a probability only of 1% being exceeded. So what should we do? Obviously we should start at the beginning with this previously well-known threshold value equation, what we did already. So we just copy and paste and modify and adapt and do all the necessary stuff. And then we should not forget that, okay, but this is a forward contract and we have to price this in. So this will be the second step to see that, okay, what is happening with the threshold? Because right now, you could say that, oh, come on, this was S0, but now we are in a threshold village, so that's why it's changing. And also we should not forget that we want to sell it, so it will be a short future position, so that's why we have this thing here. So okay, let's adapt our script, and of course we don't want to do the boring things again, so we can say that okay, but this is S0, or we can just say that this is the fast way, because in this case we have already this stuff. We need only 99%, so we can get rid of this one here, and then we can just recalibrate that. Okay, we need S0, mu, volatility, number of somethings, time, and in this case we have to be really careful because we are in the 6th month, so we need a proper time, and we can highlight it that this has been domesticated, and let's use italics because in this case we know that this is coming here to this function. Let's check it that I did the wrong thing. Why? Because we should not forget about that this equation was wrongly calibrated. This is negative, and as a result this one is also negative, so we should not copy and paste everything without thinking about this, because now we are under threshold. So we should not forget about one thing, and this is we are above the threshold or under the threshold, because this is moves this plus or minus. And here we are. So now we can say, but okay, we don't want to use this because this was calibrated for the previous job. So, well, let's get rid of this. Now we have to think about that. This is a contract, and this is a short version of it. So that's why we have to define this here. So the F. And this is minus, because minus V, then plus the present value of the K. So EXP minus R multiplied, and this is when people can go sideways. So this is still the contract exists for 1.5 years. So not confuse that it's not 2, it's not 0.5, it's 1.5 year. Because right now we are in the 6 months. Okay, and I did this. And we're supposed to have negative numbers. Why? Because right now the spot rate is under the K, so that's why it's low. And still we need some formatting to make it nicer. And it's a US dollar. And this one is the same. So we can see that now this is one chance of that the portfolio will be worth less than minus 31.2 US dollars, which is nice because at least our treasury can be happy. And now we can see the trade-off. So there is the confusion. So okay, so there is the calculated risk neutral valuation in the first half until here, and then we started to use the real world data. So that's why how can we combine all these things together, and I will